Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Well, joining me today would usually be the mayor, the governor of the great state of real estate in Texas, Mr. Michael Becker, but he is on another due diligence assignment. So we wish him and his good folks over at SPI a lot of luck in looking at another transaction. So good for him. In the podcast today, it's the professor, Mr. James Zhang. James, how are you?
Good. Thanks for having me, Paul.
Well, you're coming off of, and we haven't had an opportunity to talk to the audience about the Old Capital Conference. Any one or two bullet points before we jump into the next one?
No, I think we had probably 425 people over at the Bush Institute here in Dallas. And whether you're a listing broker, a lender, a property manager, and GP, LP, everybody was there. Sort of Dallas multifamily shut down for a day and came out and just got together. I think there was a lot of positivity throughout the panels and discussions and on the side networking. And there's not as many in-person events these days. A lot of people showed up and some people were in okay health and some people were showing up one way or another at this deal. So I thought it went pretty well and it was a good time all around.
Yeah, you guys did a wonderful job about putting it on over at the George Bush Library here at Southern Methodist University in Dallas, Texas. We appreciate everybody making the effort to come to Texas. And James and I will have a little bit more of a recap on that coming up shortly. James, you have some boys that are of age that they like superheroes. And the superheroes that I'm thinking about are the ones that you see up on the screen that they're called the Avengers. Have you ever heard of the Avengers? Maybe a movie or two?
A couple movies. I think they had one original and now they're going like character by character, it seems like.
Yeah, it's really amazing how big that platform has gotten. And when I think of the Avengers, what comes to my mind is Earth's mightiest heroes come together to learn to fight as a team. And if I was thinking about who that team would be, the superheroes, I'm thinking about the guys that we're going to talk with today as superheroes. And I'm going to make you Tony Stark, James Zhang as Tony Stark, Iron Man. And I'm going to bring in another gentleman that I think is the epitome of Captain America, Scott Dunley. And then Bruce Banner, who plays a slight young guy, but can turn into the Hulk. Well, that would be Scott Lynn. Scott Lynn is now the Incredible Hulk. Thor, who has that big hammer that everybody loves, his long flowing hair. As I look at Andrew Kyer, that he's the guy that I'm going to say is going to be Thor. And of course, who puts everything together? That's me, Samuel L. Jackson, known as Nick Fury, by bringing all the superheroes together. So I brought to the superheroes our friends, our colleagues at RECA. RECA, which you may not be familiar with, that I think you should know, is something that we have aligned ourselves with a little while ago, but it stands for Real Estate Capital Alliance. Real Estate Capital Alliance. And RECA has a number of members that are all superheroes in commercial real estate finance throughout the country. We have a couple of the guys on from RECA. Now they own their own shops, or they're part of separate shops throughout the country. Scott Lynn, as we mentioned, better known as the Hulk, he is from Dallas. He is with Cachet Commercial Real Estate, and you can find him on, I'll give all their email addresses or their websites at the end. He's in the Dallas-Fort Worth area. Scott Dunley is in the Southern California, Orange County area. He's with Balboa Financial. And Andrew is with a group out of Boston, and he'll talk a little bit more about their group out of Boston. But James, you're an Ironman. You're kind of the smartest guy in the room or so. So I'm going to let you kick it off because we're going to do a little bit of a roundtable because I want to get some more information about what's going on in commercial real estate, investing, finance, and these guys are the best of the best when it comes to financing. We bring all of our superpowers together and we help clients out on how to better finance these transactions. So my superheroes, thanks for coming to the Old Capital Podcast. We appreciate that.
I don't know how to follow that, but let's just kick it off. Let's just go around the room and talk about what you guys, obviously Old Capital does a lot of multifamily. You guys do multifamily, but what we want to hear about is what the other property types that you guys are working on, and maybe start there and then give a little bit of your background along with your firm's background as we go around. So I guess Thor slash Andrew, maybe you kick it off.
That's a wonderful introduction. Thanks for having me on the call here today, Paul and James. It's a unique way of introducing me. If people could see the fact that I have not long flowing locks of hair, but literally no hair, it changed their perception of Thor. But I like the analogy of the hammer, at least. My background has been working in the capital advisory business since 1995. So that's putting me 29 years in this business, coming up on my 30th. Was with a very large firm here in Boston, and in 2004 shifted focus and joined a firm in Boston called Hunneman, which is the largest privately held full service commercial company here in the Boston marketplace, which I run and head up all the capital advisory side of the business and capital markets. We were engaged in anything from multifamily lending, industrial, retail, office, you name it. At some point during that time frame, we've touched it. And what I like to say is we have a very kind of boutique, hands-on, white glove approach to the business, where we do a lot of underwriting on behalf of our clients, and all the way through arranging of the debt and financing to helping them close the transaction.
All right. Let's go over to Scott Dunley. I guess Captain America. I had to write that down. Captain America.
Sure. Similar to Andrew, I'm arranging financing on retail, office, industrial, apartment, medical office, and land, do ground up construction, permanent bridge financing. My company is just me and an analyst I hired from USC's real estate development program back in 2008. Started in my career at Comerica Bank here in SoCal in 95 and formed my company in 03. And I've arranged about $5 billion of financing for probably 80% of that with the same 10 customers that use me exclusively on all their financing.
All right. And then let's go to Scott Lynn. I guess the Green Hulk. You are wearing a green shirt.
I've got the green shirt on. I've learned over years and years of being in this business that you've got to learn to control your temper. So I'm not sure that the Incredible Hulk is would be. That's who I used to be, but that's who I'm not anymore. I'm a 40-year veteran of real estate finance, debt and equity brokerage. I formed a company in 92 called Metropolitan Capital Advisors. I built that up to a 26-person shop, 2 offices, Dallas and Denver, about $16 billion of closed brokerage over the 28-year history. Fortuitously, 5 days before COVID, Marcus and Milchap bought our operation. And 5 days after COVID started, I decided to pursue an investment management business that I had started in commercial real estate during the Great Recession. It turned out to be a very fortuitous opportunity for me, and I decided to focus on that full time, but I stay involved in the Real Estate Capital Alliance as a board member, and I actually use several of the Real Estate Capital Alliance finance intermediaries to execute assignments for me now.
All right. Well, I think that's a good intro. A lot of times on this podcast, we talk about multifamily and we talk about Fannie and Freddie, but maybe what we'll do is maybe take each one of the asset types that are not multifamily and talk about what you guys are seeing in that space. You know, we've seen people in multifamily sort of go into maybe 2 of the major asset types, one being retail and one being industrial. So maybe let's take retail. And if you guys have done a retail transaction recently, maybe talk about that or just what you're seeing in that space. We'll go in the same order though, but Andrew, you want to kick it off on the retail side, what you're seeing in that space?
Well, I've been shopping in retail recently, but I have not actually financed a retail location here in the Boston marketplace lately. But retail as an asset class has been doing well here in the Boston marketplace. It's good, solid cash flow streams, and we've seen an uptick in retail leasing here in the Boston marketplace, which has been very supportive of the retail growth, both in the urban center as well as out in the suburban markets. favorite asset classes of lenders tend to be grocery anchored, anything with grocery anchored retail, anything with longer term leases in place has been very popular amongst the lenders that we deal with on a regular basis.
All right. Scott Dunley or Scott Lynn, do you guys have any recent retail transactions or what you're saying in that market?
Yeah, I have loans supposed to be closing next week. So retail is the best priced lenders out there that'll compete with the agencies on apartments are going to be life insurance companies. They give you your best pricing. Obviously, agencies don't do retail. The life insurance companies, they're the best priced lenders out there for shopping centers, although there are banks that will compete with them. This most recent assignment was $10 million loan. Life insurance companies really only want to lend on grocery anchored shopping centers where the grocer is the top one or two in their respective market. And they want generally low leverage. So less than 60% LTV or less is really their target. And that's driven really more by the debt coverage ratio, and it backs into a loan to value. This loan was very low leverage. It was a 40% loan to value and about a 2-to-1 debt coverage ratio. And they're a strong grocer. And we locked that deal at the first week of August at a 5.2% 10-year fixed rate, which was a 140 spread over the 10-year treasury. It was a fully occupied shopping center here in Southern California. And the grocery store, one of the key metrics life insurance companies really want to look at is what are the sales. And the sales annual revenue at that grocery store was about $900 per square foot, which is a very healthy sales per square foot number. And that translates to a very low occupancy cost. So the rent that the tenant is paying to the landlord divided by the annual revenue is the occupancy cost, which was less than 3%. So a very, very healthy number. So we had great competition between the life insurance companies and some banks. We had non-recourse, so no personal guarantee at a 152 spread was my best life insurance company deal, which today with a 410 10-year treasury would be a 5.62% interest rate. So the treasuries are up since we locked. We had a bank that was also at a 150 spread for non-recourse. And the borrower had no partners, so it's all his money. So he didn't care about providing a guarantee and said, well, if I offer a guarantee, can you do a better rate? And they dropped the spread 10 basis points. So that was a 140 spread and great deal. We're closing next week. I'm currently just actually signed up another retail deal that's not a grocery anchored. It's unanchored. It's bars and restaurants in a beach community called Hermosa Beach. In that case, life insurance companies won't be interested unless you're talking to a second or third tier life company. And we went to credit unions because the borrower wanted prepayment flexibility so that he could pay off the loan in a year or two when rates go down or sell it. And we locked that deal at 5.69% fixed for 3 years, no prepayment penalty and a quarter point fee. And that those credit unions are always going to have a personal guarantee.
No, that's great. Scott Lynn, any recent retail transactions you want to talk about?
Well, first of all, I think that Captain Dunley or Captain America hit it on all cylinders. I would say have your COVID history available when you're going in front of lenders for shopping centers, because everybody's going to ask, well, what did it do during COVID? How bad did it get hit? Those kinds of things. But setting COVID aside, retail's the darling. I'm going to comment more on the equity side. I'm in the midst of a recapitalization of 5 shopping centers in Texas right now. One of them is in Columbus, Ohio. So it's 4 in Texas, 1 in Columbus. Solid market. They're all leased up. The average occupancy is 90%. The sponsor's been in it for 10 years and wants to get rid of some of, not, I want to get rid of is an over-exaggeration. All the deals are individually syndicated, and he wants to recap the portfolio, consolidate the investors, and basically give any investor an option if they want to get out, use the proceeds of the recap to return their capital and pay them a preferred return, or give them the option to stay in. So we're recapitalizing about $30 million on these 5 centers, looking for an equity partner. And the real issue today is valuation. Given the cost of debt And the kinds of debt that are on these centers now, it's all conduit and it's all assumable and it's all got a low fives cost in it with some decent term left. My argument would be that would be almost an enhancement to valuation today. But, the market seems to really price, regardless of what kind of assumable debt, kind of prices and values the assets on a free and clear basis. Muddling through that right now, but I would say that shopping centers have probably moved in valuation maybe 75 basis points to 100 basis points to the north. If you thought you had a center in 2021 that was valued at a 6 cap or had a bunch of credit in it or something like that, probably be valued more closer to a 7 cap. And you just have to be ready if you're going to sell something or refinance something that valuation may not be exactly what you think today versus what the market thinks.
Paul, anything to add on the retail before we touch on industrial here?
No, pretty straightforward. I mean, retail has been difficult for the last 10 years, obviously, for 20 years, for 30 years. I think it's starting to see a little bit of light, to be honest with you, in the last maybe 44 months. I'm very positive still on retail. But let's talk a little bit about kind of the sweet sister in the crowd, and that's really industrial. You guys do a lot of industrial financing. Andrew, talk a little bit about what you're seeing for industrial out there these days.
Historically, we've done a lot of industrial ground-up development, and here in the Boston marketplace, we've been able to finance that on a spec basis, meaning no tenants, just funding the construction, the tenant will come. That market now has largely been eliminated as people want to see pre-leasing in those facilities, but we were lending at borrowing at about 275 to 300 over the SOFR rate, which is the secure overnight funding rate. Today, if you're pricing at 300 over that rate, SOFR's about 4.8%. So you'd be in the high 7% range, 7.75%, 8% range, call it. We are still seeing some construction, although construction in this marketplace has largely moderated in favor of existing product. And we are doing a financing right now of a 400,000 square foot industrial building. It's about 30 miles west of downtown Boston. We're out in the marketplace right now with it to a variety of banks, life insurance companies, and some national debt funds. We're seeing the best pricing right now from the local banks, and it's coming in around mid sixes to low to mid sixes, 6.25%, 6.5%. The rationale for that, as you've heard some of these other spreads that both Scott and Scott have mentioned, has been that we have a very short-term lease with a major tenant in Walmart. We've got about 12 months left on that lease for about half the building. Anytime that you interject any sort of potential rollover risk with tenants, that then changes the risk profile, which then pushes out spreads. So that's one aspect of that transaction that we've been working through. But otherwise, I think we will get that one done probably again with no recourse. We'll have to fund both an interest reserve and maybe a rollover reserve up front or along the way to account for some possibility of that Walmart lease expiring and the tenant vacating. But industrial in this marketplace, like elsewhere in the country, is extremely highly sought after. And between multifamily and industrial, they're the two top product types here in the Boston market.
So Andrew, we talked a little bit about pricing, but let's just talk a little bit about structure. Mm-hmm. And someone comes to you and says, Andrew, I want to build on this piece of dirt and I want to buy this land that I want to put a 100% spec out there. You were talking about in the past, spec has been available. Now it may be much more difficult to do without having a potential tenant lined up to be in this industrial space. What's working right now? What's not working right now? Going back through maybe a smaller transaction between $5 and say $25 million. What's working for somebody that wants to come into that space?
What's working is having the spec aspect of it right now, I think is really challenging to get done. The benefit of the RECA organization is that it's a sharing of ideas across 18 different firms across the country. So we do share capital sources and resources on that front. So while one of us may not be aware of a potential capital provider, somebody else in our group will know somebody. And I bring that up from the standpoint that you ask about, could you get a spec development done? And I believe every Tuesday we have a capital call with a different capital provider. And I believe it was either this week's call or last week's call. We had on a group that actually was interested in financing or had an interest in financing spec industrial development. So there are lenders out there to make something attractive right now. To the life insurance companies, they're all looking for Class A industrial, Class A being defined as 28 to 36 foot clear, newer buildings, 50 by 50 column spacing, tailboard loading, etc. And for that product, you'll find a lot of interest from the life insurance companies and local banks. As you get further out into the marketplace, as you start injecting things like rollover, near-term lease exposures, it starts to get more challenging. There's more structure that's put in place.
Scott, what do you see now in Southern California? If you have had one or two industrial transactions in your Rolodex of your head, can you tell me a little bit about structures of what you're seeing out there and tell me a deal story or two?
Sure. We have last sizable industrial I did was maybe 18 months ago. It was a big box distribution center in the Inland Empire. It was a $16.5 million loan that was about 55% loan to value. The single tenant property at the time, virtually 0% vacancy in the market. That's gone up a little since then. And we did that with a life insurance company. I think the spread was around a 140, which today would be about a 5.5% interest rate on a 15-year fix. No reserves, but since the lease was only, actually, I think there was about 18 months left. It was a relatively short-term lease, and the lender, we negotiated a springing master lease if the tenant did not renew, instead of having any ongoing reserves. And the underlying sponsor behind the deal was personal recourse on that master lease, which means the guarantor would effectively take over the rent obligation of the tenant if the tenant did not renew. But the rent was about 50% below market. So the sponsor knew if he did have to trigger that master lease, he'd have no problem finding another tenant to fill the building because the rent on the existing tenant was so far below market. So that was a 5 years interest only, and then 30-year amortization for the last 10 years of the loan. And I think it was about 55% loan to value.
Scott Lynn, any comments on industrial?
Again, kind of, coming here at the tail end, I'm agreeing with both what Scott and Andrew said, and looking at it from a different set of glasses on the equity side. I put together a high leverage financing for two buildings, about 450,000 square feet in Birmingham, Alabama, outside of Birmingham. And both buildings were built on a spec basis, one of them was pre-leased and one of them was built spec. The pre-leased building had everything you wanted. It was 100% pre-leased. It was a credit tenant. But what it did not have was an annual escalator in the lease. And now most of the industrial leases are being quoted almost nationwide on new space with annual CPI adjusters. On the one hand, the lender really liked our 10-year lease, but it was flat for 5 years and bumped, and then it bumped in the second 5 years. And when it came to valuation, that was perceived as a negative. So we really didn't get as high leverage financing as we ultimately thought. So I would, on existing buildings, I'd pay especially close attention to all the existing leases. To Scott's point, if they're under market, how much under market, and then if leases are getting renewed with annual CPI increases.
All right. So
where do you see, Scott, if I can just jump in, James, Scott, where do you see leverage levels on industrial financing right now on existing product? What's
on a refi, a leased up building?
Yes.
Probably max 70% LTV.
And that would be coming through banks?
Bank conduit.
Okay.
Yeah, I mean, I think that really loan to value is largely driven by cap rates. And so cap rates vary widely from one market to the next. In Southern California, in a good big box distribution market, you're probably still a 5 cap, maybe even a little lower than that. In some other markets, a secondary market or tertiary market, you might be a 7, 8, or 9 cap. But at a 5 cap, it's tough. You can't really get 70% leverage. So I think of more in terms of leverage as your debt yield, which is a function of the interest rate amortization and the minimum debt coverage ratio for the bank or life company. And where rates are today, in the 5.5% to 6% range, your debt yield is going to be around an 8. So take your net operating income for the property, divide it by your debt yield of 8%. That's going to give you your max loan amount.
And where do you see debt service coverages from different lender types?
125.
And that's using 30-year amortization, right?
Using a 30-year amortization. Now, when you want to get that best pricing in that 140, 150 spread from life companies, you want probably a 150, 150 debt coverage ratio, and that'll get you down in that 140 to 150 spread pricing.
One more question. Where are you seeing on development for industrial in your market, Scott? Where are you seeing yield on cost? What are developers building to as far as returns right now on an unlevered basis?
In Texas or California?
Let's go around the horn here.
I'd say it's a 5.5.
I'd say it's a 5.75 to a high 6 in Texas.
Yeah, I was going to say it's probably 6.5 to 6.75 here in Boston, with no shortage of people probably saying 7.
And I think you'd be hard pressed to find a bank to do a spec industrial deal around the Dallas Metroplex today, unless it's Crow Holdings or somebody like that. And those projects are big, $100 million a box. Most of those deals get quoted at like 50% loan to cost with existing clients from big institutions.
So we touched on retail and industrial. If you guys had one more asset type to touch on that you guys spend some time on, besides those two and multi, what's the other one?
We might as well touch on office, right? There's an awful lot of office product out
There's
there.
a lot of office. I just don't know how much we've done of it. So
there's certainly a lot of people scratching their heads.
Yeah.
Office.
Go ahead.
What you're doing.
What's your comments on office?
How about if I field that one?
Okay, you start. That's
the Hulk is grabbing some necks here, and he wants to go first this time, so he's not doing the mop up. Well, again, since I'm more on the equity side, I'm the antithesis of Scott Dudley in that regard. The deals that I've been attracted to in office is when there's so much distress, it's completely unfinanceable. So we found one of those deals in Evanston, Illinois, suburb of Chicago, 3 blocks from Northwestern University, great office submarket, no place to build. All the office buildings are filled, but a seller in Thanksgiving time at 22, an institutional seller needed to sell the building to get liquidity on their balance sheet. Mentor in this business taught me always, if you're going to buy real estate, buy it when it's on sale, and institutions put real estate on sale at the end of the year. So we were able to buy an office building in Evanston at a 12 cap and $140 a square foot, but there weren't any lenders out there to make a loan on it. And believe me, we tried. We found a billionaire partner to help us close it all cash, and we did. And so that's where I really think the opportunity in office is today, is on the buy side versus on the lending side. You know, if you're out there looking and snooping around for distressed or opportunistic deals.
So do you still own that just all cash, no debt?
Yeah. We've owned it for 2 years, and we signed a 52,000 square foot lease with the city of Evanston for 15 years. And we extended our WALT from about 7 years to over 12 years with that lease. And when we fill up the remaining space, we'll go test the market again. And I think that I'm hopeful that we'll be, pleasantly surprised, and we'll be rewarded for all the risk we took closing an all cash building.
So the unleveraged return that you're getting on that, Scott, is the equivalent of what you used to get on a leverage basis with financing about, pre-COVID.
Right. Somebody asked me, what did it take for you guys to take that risk? And I said, a 12 cap or a 12% return on my cost. And stabilized, I think we're going to be close to that. Not 12, but something close to it.
Yeah, 12 cap and location in a great submarket of Evanston into Chicago, next to a subway, with a tenant that is a city that, again, has probably superior credit in the city of Evanston. So, those deals come far and few between, but I know Scott Lynn always has an opportunity for people to talk with him about maybe another opportunity that he may be looking at in the future. Talk, Andrew, a little bit about your journey, about other property types out there that we should know about that you financed.
Well, we're doing a large $40 million financing of an urban mixed use project right now that has multifamily in it, has retail, has grocery store and a fitness center. It's kind of it's an older vintage property with the commercial real estate side of it. And then the residential side of it, the apartments is newer construction ground up, 46 units. That's something that we've had a lot of interest in from people, but it's been interesting because.
And how do you finance a deal that way?
Well, historically, here in the Boston market, we would be having 5 or 6 banks at least climbing all over each other to finance it. But with liquidity issues that banks are having right now, to put $40 million out on a single asset, it's not a lot of banks willing to do that. They'd rather put $40 million across 4 different projects and $10 million in size. So what we ended up doing is going out to life insurance companies and national lenders. And we found a national lender out of Texas that's actually backed by life insurance companies to provide us with the funding. It does have a small cash out component to it. And their pricing was very good. I mean, they priced it at 230 over. It's a 5-year interest only financing. And it has some prepayment flexibility after the 3rd year, and it's non-recourse. It allows the sponsor to basically execute on their business plan, and it's a good deal for everybody.
Let's go over to Scott Dunley.
I do a decent amount of office. First quarter this year, I closed a $8 million loan in downtown Los Angeles for a 12-story office building for a client that it was about 60% loan to value. We did it with a credit union. It was a 6.5 rate, like a 3,210 prepayment penalty over a 7-year fix, but the sponsor had 4 times the loan amount in cash in the bank, and it was a recourse loan. So that's how we got that deal done. Although even with those statistics, for every 10 lenders I would call, 9 would pass. So, but we got that one done. And then
what was your occupancy?
It was full. It was stabilized, probably 90%.
Great.
He always keeps his rents low. That's why he stayed full. And then a few months after that, I was shopping a 50% loan to cost loan on a $60 million purchase of a stabilized office property outside of downtown LA. And I think we covered over 70 lenders, and I think we got maybe 3 or 4 soft quotes. The best deal we found was 45% loan to cost at a 250 spread over the treasury, and that was a life insurance company. And I was shocked that we got that done because at least 30 life insurance companies passed on that. Pass on all office, regardless of leverage, who it is, where it is, what it is, pass on all office.
It's interesting that you say that, Scott, because on my mixed use project, which is in the heart of Cambridge, did have 2nd, 3rd, and 4th floor office, a small component, 17% of the total square footage. And you could zero out the office income altogether, and it's still underwrote to a 1.3 debt service coverage. And I was amazed at how many people said, there's office in the building, can't touch it, and they passed.
Yeah. On that deal, we actually went to a number of private lenders or hard money lenders that'll charge double-digit interest rates and fees that passed on the deal simply because if they're out raising money for their fund, which they always are, the first question they get asked is, do you have any office exposure? And if you do, they're out. So they won't do it. So that deal, the borrower ended up passing on the deal. He didn't buy it. And then after that, I had a client looking to buy a Chinese national sponsor, $24 million purchase price. The best I could get him was 50% loan to cost. And we are actually under application on that $12 million loan with a Chinese-based bank that valued his guarantee because they had a presence where he's from. And that we have priced at a 230 spread over the 5-year treasury, which today is, I don't know, what does that make us today? About
5 years today is about
plus or minus 6%.
About 4%, 3.9%.
Yeah, six and a quarter, something like that. And he's buying the building at a 7.25 cap, so that gives him positive leverage.
So when you guys look at, so I'm going to take this in a different direction now. When you guys look at the sponsors on these transactions, you guys have financed a lot of deals. Are these guys only in one asset type? And are they only in one market? Like, do they niche down? Like when I was at GE, one day you'd be looking at industrial, one day you'd be looking at office, one day you'd be looking at retail in all different markets. I did not become a specialist in one thing. But when you guys are talking to borrowers and general partners, what are you seeing the best track record, sort of best success in for those guys? Anyone can jump in.
What I'm seeing from my clients, it depends on the client profile. So we call it the smaller entrepreneurial developers. What I've seen is that they generally focus within their space. So the multifamily guys develop multifamily. The industrial guys tend to just invest in industrial. And then my bigger fund type clients who've raised institutional funds are out there investing kind of across the spectrum, largely looking for multifamily industrial in the marketplace right now. Everybody, for the most part, is shying away from office. Maybe we'll look at it out of curiosity, but I don't think any of them have executed on an office acquisition. But I'd say generally people stay within their space.
Stay in their lane and stay in their market? Or are they going multiple markets?
For the most part, they're staying here in the Boston marketplace within driving range of New York. Again, when you get into the bigger institutional funds, we're seeing them go up and down the Atlantic seaboard from Boston down to DC, call it. And on the industrial side, seeing some of those groups reach outside of New England just for better diversification and better opportunities, find things maybe with a little better yield than they're able to capture up here in the Boston market.
Scott Dunley?
Sure. It's varied, similar to Andrew, although I don't have any institutional type customers. My clients range from maybe 100 million of assets to 750 million. And, I've got one client who all he does is office, but he's been fortunate because I've made fun of him for years for why are your rents so low compared to the market? And he says, because they never leave when rents fall. And there he goes. He's got a stabilized office portfolio today. And I've got another client who owns, 1,700 apartment units. He's got couple of Class A medical office buildings, couple of Class A creative office. He owns some industrial buildings. He's got some land that he's got entitled that he's going to build apartments on. So it's really kind of across the board. I would say it's more, yeah. And then I've got another client who he's got about $700 million worth of grocery anchored shopping centers and maybe a couple of small office buildings, but really it's all shopping centers. So I would say it's really kind of across the board. Some own they pick their product type they're good at and they stay in their lane, and some want to be completely diversified. So it's really kind of across the board.
All right. Scott Lynn?
Well, what I was going to mention is just that, amongst the active participants in RECA and the membership in RECA, it's 18 firms plus or minus a head count of about 80 brokers. And amongst all of those various financiers, I'd say you'd see just about every product type and deal structure outside of multifamily, which I know is the old capital specialty. And so, as Andrew said earlier, we share a lot of information amongst us. It's like having a dashboard of what the capital markets are doing for a product type in any given time. And the feedback is, market closings, because the membership sees that. That's not, information we necessarily make public, but amongst the membership, it's proprietary information that's shared very openly. So it gives anybody that's looking at a particular product type, say if you call me in Dallas or you call Scott Dunley in California or Andrew in Boston, and one of the three of us doesn't know anything about the kind of product you're looking at or the location or whatever the metrics of the deal might be, it's easy for us to come up to speed or to get access to an expert so that we can become experts. It's all about information and getting access to the best and quickest information.
Working as a team like the Avengers. Last question to go around the table here. We're coming towards the end of 2024. Crystal ball time. Scott Lynn talked a little bit about, people have gotten comfortable about receiving 5.25% in their money market accounts. Is equity flowing into what market? Where do you see it? And then Andrew and Scott, talk a little bit more about, where you see the opportunities in 2025 are going to be. So Scott Lynn, kick it off and tell me a little bit more about where equity is flowing to these days.
Well, look, there just hasn't been a lot of transactions new transactions for the last couple of years. There's a lot of money sitting on the sidelines. It's deal driven. Everybody's looking for distress. Everybody's looking for opportunistic. Everybody's looking for something that looks just better than anything else that they've seen recently. And so, I think you have to differentiate with some kind of a story to raise equity capital. But if you have a good story deal, I think you'll get attention.
Andrew, Scott, talk a little bit about lending, investing dollars. Where are you putting your money at, and where are you putting your clients' money at these days?
What I expected 2024 has been a period of kind of readjustment here in our marketplace. I think you've seen lending be very tight in 2024 as banks have been working through their liquidity on their balance sheets, trying to get loans paid off to put more cash on the balance sheet, because the way banks work is they lend money, then they get paid off and they recycle that capital and they relend it. The recycling part of the market hasn't been functioning in 2024, so I see that changing in 2025. I think when we all come back in January, I think everybody has their new programs. I think lenders will have been through a lot of their liquidity issues. The regulators will have been through their institutions, and I think we see a more optimistic 2025. I think there's also, as Scott was saying, somewhat of the cap rate play here. I think everybody's been waiting on the Fed to drop interest rates, and that really hasn't materialized. It did most recently with the 50 basis point reduction, but that's a start. I think everybody's kind of of the mindset that rates will go down further, and when rates go down, cap rates will go down, and people will get back to valuations where they feel comfortable trading. And when that happens, I think the market gets back to kind of a positive growth and equilibrium. So I think you start seeing more of that in 2025, and I do think you see distress start to hit the streets next year as banks now have stabilize their balance sheets and have room on their balance sheets to write down some of these assets that are non-performing. And so I think you see an uptick in that market next year as well.
Scott?
Well, I think the bond trade was the place to be in the last year. I'm glad that I bought as many 10, 20, and 30-year bonds as I did when it was north of 5%. That's over. In fact, I would say that we've already seen the lows of the 10-year Treasury about a month ago. It's up 45 basis points since then, and I don't see it returning back to that level again for a long time. I don't think we're going to see Treasuries compress. Maybe it'll go back close to that level where the 10-year was at 365 or something, but I don't see it going below that. If you look at the long-term spread of the 10-year expected inflation rate and compare that to Treasury rates, there's really no reason why it should be below 3.5, 375. On the real estate side, I think the deflexing of flex is where you're going to make your money. Office values are down 30, 40, 50, 75%, depending on where it's located. Industrial is down maybe 10 or 15%. So people can pick up those originally built as industrial buildings that were converted into office space because the office was getting higher rents than industrial. You go buy that building, you rip out the mezzanine, you lose square footage, but you're going to have a lot more demand for that industrial space.
Got it. James, put a bow on it.
So, Scott, real quick, you just crushed the dreams of everybody waiting to refi when 10-year went down to 3.6 with that comment.
Yeah.
But yeah, I mean,
I'm probably wrong.
Nobody knows, right? But yeah, I think it's interesting to hear about some of these other asset types because a lot of times people call us and they just want, hey, I'm doing a commercial deal now, so I'm getting non-recourse and I'm getting 5 years IO and 30-year AM and 80% leverage, right? And I'm like, well, if you're doing an apartment and it qualifies with 125 debt service, sometimes people jump over to these other asset types because they maybe grew up in multifamily and then they go over to retail or they go over to industrial and then they realize that, yeah, it's not as straightforward. You're going to need more down payment. You're going to need a little bit more money set aside for when these tenants roll over. No, it's great to hear from everybody about what's going on out there. And it seems like the cap rates outside of multi and industrial, you can definitely get a higher yield, but you just got to be prepared to probably hold a little bit longer and have more cash reserves on those deals.
Yeah, I thought we had some great information that comes from, I would say, our superheroes with RECA today. Again, Real Estate Capital Alliance. You can find RECA on the internet under RECA, RECA.us. Go to RECA.us and you can find the members of parts of RECA, and we're part of it. Andrew's group, Scott's group, Scott Lynn's group is part of it. And of course, Old Capital is part of it. In that we wanted to highlight some of the kind of the smartest guys in financing today and get their perspective throughout the nation. I'd like to try to do this maybe on a quarterly basis and just kind of talk a little bit more about what's going on out there so we can bring value to you and your investors today. So Scott Dunley, we certainly do appreciate spending some time with us. Scott Lynn, thank you for hanging out with us. Andrew Kerr, appreciate hanging out with us. And Mr. Tony Stark, James Zhang, thanks for hanging out. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.